I think one of your first ideas, Sarat, is pretty interesting, and that is, and we've thought about this, how many people have not been to the doctor or have neglected other health concerns, like elective surgeries. So one of your plays is all the backlog for elective surgeries, and tell us about it.
It is, Joe. It's the company called Zimmer, and you know, if you look at the last 12 months, the elective surgery for knees and hip replacements have not been that great, not just in the U.S. but globally. Zimmer's got a great balance sheet, a lot of money into R&D, and I think the products they have going forward are higher margin than they had before. So as we know, there's a lot of pent-up demand, not just for going out, but also for people to actually pay attention to their own selves. So one play that you know, this is one that we really like, a great balance sheet, and really coming out of what we just had, the pandemic, they've reorganized their whole operating structure too. So I think you're going to get a lot of upside in the cash flow as well. And then just to add to, you know, sorry, go ahead.
No, I was just going to say, I just wonder if you get back, what percentage of the people that should have had electric surgery do you get? You don't get 100. Some people, I guess, never to get what they have, but you get a lot of it, plus whatever people need starting in 2021.
Exactly, and you know, as people talk about the pandemic, 10 or 20 pounds, you know, they're going to need surgery, or they're not going to be as active. So that's going to be an increased demand for them as well. And our population is growing, right? So you look at the middle class that has more money. That's going to be a great kind of positive tailwind to a company like Zimmer.
On March 31st, CNBC wrote a piece about medical tech stocks, citing a Wells Fargo report that says that some of the tax increases included in the infrastructure plan would weigh on medical technology stocks, some specific provisions. I don't know if it changes with what we were just talking about, because it's not 100 million anymore. It's up to whatever it is that we were just saying. But is there any concern that regulatory or tax issues could hurt that group?
I mean, obviously, you're going to have a little bit of headwind on that. But, Joe, I like this company, Zimmer, because it's not just you're going to get the replacements. They also have really innovative products, and people will pay more for innovative products. Surgeons want this type of equipment, you know, into their patients. So I think there's a much better offset on the positive that we're going to have demand for greater products. But it will be some type of headwind there as well.
And like so many things, your next pick, you think about a lot of people that maybe were at home imbibing a little, but we forget restaurant business, bar business has been nil. So these companies that sell into that could have a big rebound, like the one you're going to mention.
Absolutely. So you're referring to Diageo. 85% of Diageo's revenues are in the spirits business. And really, when you take away the restaurant business, the travel business, the cruise business, these are all high margin products where consumers now want to spend money. They have the money. They will spend it on products such as single malt scotches, vodkas, tequilas, which will really drive you know, the bottom line for a company like Diageo, which also has 2/3 of its revenue overseas. So a combination of those, when you've got companies like a Diageo that are really going to, we think will have some upside to their earnings.
And American Express, what's that? You like Amex just as people start traveling again, using their cards, or what's the rationale there?
Yeah, I've got a couple reasons for Amex. You know, the stock was pretty badly killed last year, but if you look at Amex's growth, it's at the higher end consumer. It's also at small businesses spending. Travel and entertainment is going to come back. All the things that were just shut down for many, many months, you're going to see consumers and business come back, kind of spending with a revenge. And this is a stock that has a great balance sheet. Again, Amex is known for its operating leverage, and I think as we go into the next 12 to 18 months, we expect to see some upside surprise here. But we also expect to see companies, consumers globally spending a lot more money. And where are they going to do it? In a cashless way, as we know. And Amex is going to be a huge beneficiary of that.
Shepard Smith here. Thanks for watching CNBC on YouTube.